Good afternoon, everybody, and welcome to our bi-weekly macro webinar. Patrick Ganley here, along with Angus Geddes. Angus, how are you today?
Yeah, good. Thank you, Patrick. Always good to be here on a Thursday.
Okay, and I know we got a lot of things to get through, or a lot of big things to get through, because there's been a lot of news flow about certain things that are affecting the markets at the moment. But before we get into that, again, here are your presenters: Angus Geddes, founder and CIO; Patrick Ganley, Chief Operating Officer and Head of Wealth Management. Little bit of housekeeping disclaimer. Please be reminded that all the information today is on a general advice basis. Before acting on any of the specific investment objectives, please be sure to consult a financial advisor before doing so. And please remember, everybody, that past performance is no indicator of future returns or performance. Comments and questions, you'll be able to populate the screen here where the orange arrow is if you have any questions, and Angus and I'll endeavor to get through as many of these questions as we possibly can. If you can't hear us for some reason, you can check the volume on your PC, check the speakers are plugged in properly, check your headphones, check your sound settings. If all of that doesn't work, please give us a call, 1-300-88-1177, and we'll look forward to trying to help you get connected. So without further ado, Fat Profits market update. Angus, I thought we'd just start with a little bit of a comment. The S&P books back-to-back losses as Wall Street grapples with a rocky start to September. And I think we'd start off with a chart here on the S&P 500, and it has been a choppy start as you kind of thought would happen. So I thought we'd pass the S&P over to you at this time.
Look, I think, for now, that big resistance level of just above 5,600 on the S&P 500 is proving to be fairly formidable. We're heading into the seasonally weaker months of September and October. And I think, the risks are skewed to the downside over the next sort of 4 to 8 weeks. I think, we're in for a fairly choppy move to the downside. The question is, what sort of magnitude is it going to be and what's going to cause it? And I think, looking at the technicals, we saw a fairly decent rebound off that, just below that 5,200 level, 5,100. So I think, at a minimum, we could see the market retest this in the next 4 to 8 weeks. We've got quite a lot of uncertainty around the US election. It's going to be fairly closely run, and depending on the outcome of that election, it's going to have implications for the financial markets. Secondly, we saw a pretty muted response to Nvidia's profit result, and I think a lot of that hot air that's sort of priced in to some of those AI names, and in terms of those expensive valuations. I mean, I think there's further to go on the downside there. Nvidia actually did quite well. It actually had a moderate beat in terms of estimates, but the market sold it out anyway. So I think we've probably got further rotation and further profit taken to go in that sector. The other point really is that valuations are high. The S&P 500, the PE got up to sort of around 21, 22 times. So if we have any kind of concerns around growth, around the state of the US economy, if we get a weaker non-farm payrolls number tomorrow than what the consensus expects, then we could see a further risk-off move in the US market, and I think that has obviously implications for the rest of the world, given that the US financial market set the pace for everyone else. And if anything, as we head towards the end of September and October, we're going to get some companies coming out with lowering guidance, and we're going to get some earnings revisions to the downside. So I think there's some risk there. We saw quite a big shift higher in the VIX up to sort of 30. I don't think we're going back to 65 anytime soon, which is the level that we saw last week. But it doesn't mean to say that we might not get some further selling over the next 4 to 8 weeks. So I think it's prudent to have some cash And as we were sort of saying a few weeks ago, it's prudent probably to be, sort of pruning one's portfolio and getting ready to deploy cash in October.
So yeah, I was going to ask you that question. You recently built up some cash through the managed accounts and the listed investment companies, anticipating a bit of a sell-off here through September and October. Are you still seeing that? And would you say patience is the name of the game at the moment, to just kind of have that cash and be patient and wait for the right opportunity to get back into the market here?
Yeah, I mean, absolutely. I think it's not a question of going 100% cash. We've only sort of gone 10 to 15% cash, but yeah, I do think there could be some opportunities, and we can talk about some of the stocks that we're looking at. I've got some charts that we can talk to later on in the webinar. But I also have to say, some of these big technology stocks in Australia and also overseas, they could be some quite opportunistic buying in those, particularly if we see lower levels on the Nasdaq. And I'm totally expecting some of the hot air that got priced into those stocks to come out in the next 4 to 8 weeks. So yeah, closely watching the situation.
Okay, with that in mind, I thought we'd have a look at the Nasdaq here, and I know you spoke a little bit about some of the tech stocks that got a bit beat up here recently. So maybe we can talk to this Nasdaq chart here.
Yeah. So look, the primary uptrend at 16,000, which is also the breakout level from earlier this year. I don't think there's any threat to that at this stage, but the way the Nasdaq retreated from that rebound high of 18,000, it's come off quite quickly, has failed to maintain momentum and take out that record high. What this sort of says to me is that the Nasdaq is in correction mode, and it's probably going to lead the markets and the major benchmarks lower. There's further to go, I think, in terms of this unwind out of tech stocks and this rotation into other sectors of the market. So yeah, I think there's more downside to come in this correction, which started early August, and looking for a bottom in the index sometime late September, certainly sort of by mid-October.
Okay. And with the ASX, I mean, the ASX got hammered yesterday. Why were investors overheating their sell buttons, do you think? And here we got a chart of that, but it was a pretty bad day yesterday on the ASX.
Oh, look, I think the big catalyst yesterday was obviously the GDP. Australia's sort of going through tough times at the moment, arguably the worst retail spending recession we've seen since the early 90s. The RBA doing their best to get the inflation rate down, but it's hard when you've got fiscal spending from the government on the other side and hiring in the government sector, and then high rates of immigration. So it's a balancing act. Look, there's nothing to worry about in terms of the technical setup for the ASX 200. I think if we do get some volatility over the next 4 to 8 weeks, 7,600 will prove to be a fairly formidable support zone. It took a number of years for the ASX to really climb above that level. So, just as we talked about the pullback in the S&P 500 down to sort of that 5,100 level, possibly being on the cards, I'd look at 7,600 as being a buying opportunity for the ASX. What could get it there? Well, uncertainty around the US election might see a sell-off over there. More importantly, we might get economic numbers coming through that show that the economy in the US is deteriorating faster, or deteriorating at the edges, and the unemployment the labour market's deteriorating faster than anticipated. So a lot's riding on the non-farm payrolls, which comes out tonight. I should say on not tonight. It comes out Friday morning in the US, Friday evening our time. And I think that is going to set the pace for the benchmark indexes, and including us. You know, at the moment, I think it's quite commendable that the ASX 200 has been managing to push up to near record highs, despite the fact that we're nearly in a recession. So that sort of gives you an idea of the underlying strength in this market. We are in a bull market. The stock market is not the economy, and the economy is not the stock market. So, you know, I'm encouraged by all of this, and I think, you know, 70,000. If we saw 7,600 on the ASX, it would be time to get in and go back to 100% invested. So that's kind of the playbook, Patrick, for us for the next sort of 4 to 8 weeks.
Okay, and I just wanted to ask you this question. I mean, we saw that early August drop in the market, and then we saw the ASX kind of go through August and kind of pick up a lot of what happened in the beginning of August. Did you see any similarities between what happened at the beginning of August and what we're seeing here in September?
Yes, I mean, normally when you get a jolt like what we saw in August, and a big rebound, but a rebound which fails to take out the previous highs, and we're seeing that heavy resistance. You know, we talked about 5,600 on the S&P 500. You know, it's 8,100 for the ASX. Normally, there's always a second leg to the correction. You know, it's a sign of what could come. Personally, I think it's going to be growth scares, concerns around the soft landing in the US, concerns around China slowing down, and we're going to talk more about China later on. And obviously, we've seen the commodity prices get knocked around a bit in the last couple of weeks, which is, you know, translated to weakness for the resources sector. So I think, you know, there's a number of factors out there that could be the trigger point for another leg down in this correction. I think, you know, we saw the opening shot on Monday, and I think there's probably further to go. So yeah, we should just be braced for a bit more volatility. I don't think it's going to be anything worse than much more than a 10% sell-off. And you know, I'm looking to October to redeploy cash.
Okay, so and now I thought we'd touch a little bit on the US dollar. I know this has been a theme that we've been talking about quite a bit on our sessions here for members, and you know, obviously it looks as if we're getting closer to a point in time where the Fed may start to lower interest rates, which would have some impact on the US dollar, don't you think?
I think it's going to have quite a negative impact on the US dollar. Technically, you know, the DXY, it broke out of that converging triangle. It's had a decent move down to 101. It has yet to really stage a meaningful rebound. And we're seeing other currencies, I'll write about this next week, about the latest one, but we're seeing other major currencies now beginning to outperform against the US dollar. And I think this represents a meaningful shift. I think over the next 6 months, it'll be interest rate differentials that have an impact on the greenback. And you know, our playbook is for the DXY to break below 101 sometime this year and go lower. What would cause that? Well, I think, you know, the Fed cutting rates faster than other central banks could do it over the near term. Why would the Federal Reserve cut rates faster than other central banks? And the answer to that question is they had to put rates up much more aggressively because US mortgage borrowers are much more insulated against higher interest rates than most other countries around the world. The Fed had to take the Fed funds rate up to 5.25 because 25% of US mortgage borrowers had locked in prior to the pandemic ultra long or post-pandemic ultra low interest rates. In fact, the average mortgage rate is 4% for that segment of the market for a very long duration. So well protected from these rate hikes. So it stands to reason the Fed will now have to bring down rates faster, particularly if the US economy is beginning to show signs of deterioration, particularly in the labour market. And I think that's the kind of noise that we're sort of hearing from some of those Fed officials. That's where the concerns are. So they don't want the US economy to fall over. So they probably have to move quite quickly. So that's why the non-farm payrolls data tonight is so important. We get a weaker number coming in below consensus of 185,000 jobs being added. We get a weaker number. The case will become quite compelling for them to go 50 basis points at the FOMC meeting in a couple of weeks. If it comes in line or even slightly above, I think they'll still go with 25 basis points. So there we have it. I think they'll bring down rates faster. That's going to put downward pressure on the dollar. So we're looking for a downside break below that 101 level prior to the end of the year. Technically, this chart tells us that the rebound's coming, and that could happen if the jobs number comes in stronger than expected. We could see bond yields back up a bit. We could see the dollar up a bit, but I don't think that's going to disrupt our secular call of the US dollar being in a long-term bear market.
Okay, and also in that, the U.S. recent reporting manufacturing activity. The world's largest economy declined again in August. So you think that's playing a bit on this as well?
Yeah, I think the manufacturing has been deteriorating over there for a while. The thing that really sort of alarmed me was just how tough those discount dollar retail chains have been doing in the US. I mean, Dollar Tree and Dollar General, which carry very, very low prices, have seen their earnings come under, enormous pressure. So, it really sort of points to, consumers dialing back their spending. We've seen some of these big consumer stocks, such as Nike, under pressure for some time. So, yeah, I do think that we're seeing the fraying of the edges, and consumers are beginning to be a lot more wary. So the big thing is the unemployment rate. And if we were to see 4.3, 4.4 on the unemployment rate in coming months, and less jobs being added, that's probably going to spur the Fed into quite aggressive action. And I think this feeds back in the form of a lower US dollar. And if the US dollar goes down, provided global growth holds together, we could see a decent rebound in the commodities, over the next 6 months.
Okay, and we have that Fed meeting this month, September, towards the end. I think it's the third week in September, so I guess all eyes on that meeting, and we'll see kind of what the Fed does with their interest rates. So I thought this was an interesting chart that you popped in here today. So maybe you can talk to us all about this at the moment.
So look, we talked about, we discussed, over the near term and the medium term, interest rate differentials driving the US dollar down, as those the spread between US yields and the rest of the world begins to narrow, and it could come in quite quickly. I think that's going to undermine the US dollar over the near term, but looking out further out to the bigger picture over the longer term, this graph that I actually put together using AI this morning shows the gap that's going to open up between the US debt and the US GDP. Back in 2012, GDP and the national debt were more or less the same. But if national debt continues to grow much faster, much quicker than nominal GDP, then that sheer amount of indebtedness is going to weigh down structurally on the US dollar. And I think regardless of who wins in November, whether it's a Democrat or a Republican win, there's nothing that's going to stop that freight train. So yeah, quite bearish on the US dollar, and we're seeing that play out. So that has to be good for commodities. And I know commodities have wobbled recently over concerns around China and concerns around the US economy, etc. But I think they will ultimately hold in and reset to the top side, particularly if the US dollar comes off, because you know, for the rest of the world, you know, oil is now getting a lot cheaper.
Okay, so I thought we
and indeed other commodities.
Okay, so we can, talking about the commodities here, we can talk about gold. You got an interesting gold chart here. And I know gold's been a theme and something that you've been speaking a lot about as the US dollar comes off. You think that'll be a good environment for the gold price and the gold producers?
I think gold, physical gold, has been remarkably steady in the last 5 weeks. It's really detached from volatility. You know, we saw vol spike to 65, one of the biggest vol spikes in the last 4 decades. Normally, gold would have been sold off with every other asset class, and it hasn't. It's been remarkably steady. So, you know, that just sort of says to me that deeper pockets are accumulating gold, and I think, you know, it's only a matter of time before those financial flows, you know, as defined by what retail and institutional investors do, they start accumulating it, and we'll see those spot gold ETF holdings begin to rise. You know, we've seen quite dramatic outflows this year, yet record prices in gold. So I think, you know, gold's readying itself for the next leg higher, and certainly, you know, if the US dollar comes off, there'll be a lot of investors out there that see precious metals and gold as a hedge.
Okay, and we've recently seen Brent crude oil has been coming off and amid demand concerns, and I thought we'd pop this chart up on the oil and the energy sector.
Yeah, so it resolved that converging triangle with a break to the downside. That's quickly come back to historical support on the 5-year weekly chart, which you know goes back to the fourth quarter of 2021. I've been surprised at the weakness in crude oil. I didn't think it would get back to 69. You know, in the last couple of months, I thought, you know, it was gearing up more for a topside breakout. That is still our base case, that global growth does hold together. We get synchronized rate cuts coming through from all the central banks next year, and we see, you know, economic growth not just in the US but around the world begin to return, and we also see the Chinese economy stabilize. Now the caveat is, what happens if oil breaks below 68, $69? Well, that would be a bad omen, I think, and that would say to me that concerns around growth are going to become more pronounced over the next 4 to 6 weeks. We talked about the next 4 to 6 weeks being choppy, and I think, you know, there's certain trigger points out there and catalysts that could cause that. If oil breaks below $68, $69 a barrel, I think there'll be a lot of traders looking at that and worrying about the state of the global economy for oil to do that. So yeah, you know, I mean, this is all part of the parcel. It all goes into the mix, and we just got to keep an eye on the energy complex.
Okay, we spoke a little bit about gold, so here's the Aussie gold price.
Yeah, I just want to sort of talk about Aussie gold in relation to the next slide after this as well, which is the gold miners. I mean, it's been disappointing that despite the fact that, you know, we saw gold sort of pretty much hold up near the record highs and make new record highs, and yet the market has just sort of almost indiscriminately sold down the gold miners. So the volatility is tough, I get that, but, you know, we can see from this chart that the Aussie gold price is headed a lot higher. I continue to think that gold miners in Australia and internationally continue to screen cheap, and that we should be accumulating them. They're not immune from a risk-off move in the markets. They did actually hold up comparatively better, but it has been frustrating. But I do think their day is coming. And whilst we might see a bit more volatility in the precious metal mining sector, precious metal mining equities, over the next sort of 4 to 8 weeks, you know, there's a big recovery and a big rebound coming. Now's the time to be accumulating, not trying to trade them. And I think
Okay, here's the second chart.
Yeah, sorry, Pat. This is the ASX Gold Index. It's a similar pattern if we use the Philadelphia Gold and Silver Index, the Huey, or the New York Stock Exchange ARCA Gold Bugs Index. Similar setup. New record high back in 2020. Big consolidation between 2020 and 23. We've seen the breakout above that neckline, that big resistance level. I think the ASX All Ordinaries Gold Index goes straight back up to 9,500 and retests those record highs. So I'd be accumulating gold stocks on weakness, not buying into the strength, but on buying them on bad days. And we might get a few of those, as we head towards the end of October.
Okay, and here's one stock that I know you've been interested in for a while.
Yeah, look, I think Northern Star have done a great job. They've continuously met expectations. The market likes this one. They've been consistent and reliable. More often than not, they meet guidance. There's no negative surprises for the market. It's very well managed. And I think, this gold stock, if we saw it sort of coming back to its primary trend line at around 13.5, 14 bucks, I'd be looking to add to this. Another one that I like, of course, is Evolution, which has got a mixture of copper and gold. But I like all the gold stocks, most of them in Australia. But this is one to put on your shopping list. I think if there is, any further volatility, overcoming weeks.
Okay, we mentioned we talk a little bit about the Hang Seng.
Look, we've all heard the headlines. We watched the news. We watched the iron ore price at $93 a tonne. We wonder what's going on in China. We hear all the gloom about the economy and how bad a state it is. So I really wanted to put the Hang Seng up. The CSI 300 has a fairly similar technical setup. Despite all of that, the index, since breaking out that primary downtrend earlier this year, has managed to consolidate above 17,000. This index looks like it's forming the first important step above the base. And, I'm expecting a recovery up to that 19,500 level that we saw earlier this year, possibly before the end of the year, certainly within 6 months. And this is what bull markets do. They climb a wall of worry, particularly when they're early stage, like this one is. So yes, I think the Hang Seng put in a textbook double bottom between 22 and 24. I think we've seen the lows, and I think from here on in, we're going to see this benchmark climb a wall of worry. So the narrative around China is gloomy, but the stock market, which is not the economy, the stock market is no longer going down on bad news. And that is what you want to see at the early stage infancy of this bull market. Because it was such a debilitating bull market, this recovery, this new cycle could have, quite some time to go. And we know that those valuations over there have hit rock bottom. So, I'm cautiously optimistic, and we can talk about a couple of stocks later on.
Okay, and we know that the Chinese residential and factory activity remains in the doldrums. Do you think that's going to turn around anytime soon?
I think they're probably addressing some of the imbalances in the economy. They've been accused of overcapacity, flooding the global market, overproducing. We know that Trump's probably going to raise tariffs. So some of that doesn't surprise me if they are sort of cutting back some of that production. The big mission for the Chinese government really is to get the Chinese consumers spending. And at the moment, they're not. They're sitting on a huge cash pile in terms of domestic savings. but they're hoarding it and they're not deploying it because, you know, there's all this uncertainty around the property market. So, you know, they don't want to fire the bazooka. They don't want to just launch an enormous amount of stimulus that creates another big asset price spike like last time. But they'll just keep chipping away at it. You know, the Chinese government, at the end of the day, have got to keep throwing sort of cumulative sort of stimulus measures, you know, until they get a result. So yeah, it's challenging nevertheless. But I'll come back to this slide. You know, the Hang Seng's no longer really going down and making new lows below 15,000 on bad news. It's holding above 17,000 quite nicely. So we'll continue to follow this chart.
Okay. Now that we've spoken about the index, I know there were a couple stocks that you wanted to talk about, and we'll start with this one here.
Yeah, so Alibaba is looking really interesting. This is a bellwether China mainland tech company. You know, it's a behemoth. It's the equivalent of you know, an Amazon or a not so much an Apple, but it's the equivalent of certainly probably an Amazon. You know, given what they're doing with the cloud over there. You know, this stock is just grinding higher now, and I think, you know, the inflection's in. It's traced out this big bottom, which has been tested at around that $65 mark on multiple occasions. You know, and I think the path of least resistance is up. So this would be one stock that I'd be buying and holding it for the medium to longer term. I think the scope for a recovery, a decent recovery here over the next few years is significant. And, you know, it carries a very low valuation multiple.
Okay, and the second stock I know you wanted to talk about?
Tencent's another huge behemoth that operates, you know, in China. And again, you know, we've seen very constructive price action in Tencent. You know, it's outperforming its benchmarks, it's outperforming its peers, it's doing its own thing. And, you know, and this comes after a huge reset, you know, back in 2021 when the stock topped out at sort of Hong Kong dollars. I think it got above 700. So this is another one that I'd be putting in the bottom drawer and tucking away. And, you know, I really believe that, you know, if we did get a bigger reset, some of those US tech stocks rotating into some of these Chinese bellwethers probably makes sense.
Okay, and I know we had another stock here listed in Australia that you wanted to have a chat about.
Yeah, so look, you know that the Australian economy is doing it tough when a formidable quick service restaurant format like Collins Foods, which, you know, has 300 KFC stores in Australia, you know, when consumers are dialing back from spending money on KFC and Domino's and McDonald's, and they're spending their money on groceries, that, you know, the consumer is doing it pretty tough. You know, we're in, and I think indisputably, we've got some of the toughest retail spending conditions since the 91 recession. So, you know, the company came out, they warned about it, they said that, you know, consumers were dialing back. If there's any volatility in the next sort of 4 to 8 weeks, Collins Foods will be on our shopping list. We may well have seen the lows, but we might see the stock pushed down to $7. We might see it go below $7 to the high sixes, but this will be one that I'll be buying. The time to buy is when it's priced for recession, when the recession or recession in spending. And I think, you know, it's really only a matter of time now before the RBA starts cutting rates. My strong high conviction view, Patrick, is that the first rate cut will be in by Xmas, and that will pave the way for a fairly aggressive easing cycle next year. So, you know, that's got to help the retail spender. I mean, obviously the mortgage rate have been hiked to, you know, 6.5%, 7% in Australia in some instances, 6.25% to 7%. because of the cash rate, which is at 4.4. I think there's going to be at least 100, 125 basis points of cuts play out over the next 12 to 18 months. So yeah, looking for Collins Foods to make. I'm looking to buy Collins Foods if we see any big volatile down days in coming weeks, and we see a bit of capitulation from investors and everything, and the handbasket getting thrown out the window. This is one stock on my shopping list.
Okay, so I wanted to talk to you about a few other things, Angus. I mean, those GDP numbers released yesterday in Australia for the June quarter showed growth of 0.2%. As inflation and cost of living continues to bite, it marks the worst performance since the end of the 1990s. Do you think this will really be on the RBA's mind as we head into the end of the year, and that they'll probably, move on interest rates sooner rather than later? Because that was quite a big shock to a lot of people, I think, yesterday with what came out, pointing that we really are in a bad way. We are in recession, and it's as bad as it was in the 1990s.
Yeah, look, I think we are in a bad way, and let's not also forget that that data was for the June quarter. The ships sailed past that point since then. So, I think by the time we get the September quarter data coming in, the case will be galvanized for a rate cut by year end. The only thing we haven't really seen is the employment data, and I expect that to really start heading south soon. We know that the private sector's pretty much stopped hiring. It's really only been public sector hiring that's held the unemployment rate up. And so I expect further deterioration there. The other thing is, the inflation data is backward looking. Some of the components that led to the elevated inflation rate will back out over coming quarters. So, the inflation rate could come down quite sharply now. So yeah, I think bottom line, rate cuts before the end of the year.
Okay. And with the unemployment number, do you think we'll see it over 5% soon?
Not sure about 5, but wouldn't surprise me if we saw it push up to 4.5. And that would be a cause for concern for the RBA.
Okay, a couple questions from the members I'll go into for you. Are you done with that one?
Yes, yep, thanks, Pat.
Okay. Does the large U.S. debt really matter to the U.S. dollar? The debt spiked in 2020, and yet the U.S. dollar has been strong for the last 4 years. That's a question, comment, statement from a member. I didn't know if you had any comments on the.
Sorry, what was the question around the debt spike?
Yeah, does the large U.S. debt really matter to the U.S. dollar?
It does. It does, because we know that the US government are never going to default on US bonds they issue to finance their spending and to finance that debt. We know that they're never going to go broke because they can always just print money, and we've seen that happen. The precedent for that happening is high. We saw it happen during the pandemic. We saw it happen during the GFC. Will it happen again? Well, I put that graph up before showing that, yes, indeed, it could happen. Now, we're getting to a point where the national debt over there is growing at a faster pace than the size of the US economy. So the bottom line is they're not going to be able to pay that debt back anytime soon out of tax receipts and taxes, and they're going to have to make up the shortfall. And the bottom line, that means printing money and increasing the supply of dollars. So it does matter. It does matter. And they've got 55 trillion of future unfunded social security and welfare liabilities falling, over the next 10 to 15 years. So I think the writing is on the wall. And we've got this all sort of occurring and playing out at the same time as other countries are buying less dollars, and de-dollarization is real. After how quickly the US government were able to shut down Russia with sanctions and basically take them off the global financial grid and lock them out of the US dollar system, it's no surprise that we're seeing central banks around the world diversify out of US dollars and other US financial assets and put it into physical gold. So yeah, the bottom line is it does matter, and I think we're going to see much higher levels in precious metals and gold, which I think is going to be in a huge bull market as the dollar enters a secular bear market, which could run for a number of years.
Okay, so I'm going to try to aggregate these questions up from the members, and it seems to be, quite a bit of interest and quite a big, a lot of questions in and around BHP, Fortescue, Rio, iron ore, and the resource sector in general. And just, kind of with the weakening in China, they're just asking kind of what's your confidence in the resource sector at the moment, given everything that's happening with iron ore and, some of these big companies seeing their share prices fall?
Yeah, look, it's been concerning, and I do understand that. But let's just break this down. We've talked a lot about gold today on the webinar, Pat. Let's talk about iron ore. We know that BHP and Rio are the strongest, most competitive producers on cost. Their cost of production are $30 a ton. All the marginal cost producers at 80 or 90 are probably close to losing money now. So the issue for the iron ore market really is just how long they continue to produce at a loss. And I think that's really the first point. The second point is China's pretty much stopped building housing. Demand has held up, but it's been going the steel's been going into infrastructure, it's been going into manufacturing, etc. But it hasn't been going into housing, and it hasn't been going into housing for some time. You can't really blame them, given that they've just gone through a housing bubble 3 or 4 years ago, where they overbuilt. We all saw those pictures of those empty residential, housing blocks. So they've had to clear that backlog, and that has been going on for some time now. They're not building any new residential, and the existing backlog is going to be repurposed, but at some point they will. So look, whilst there are concerns around China, I think, at the end of the day, I think China has to keep growing. They've got to keep that economy on trajectory. Otherwise, the Chinese government, Beijing, are going to be under a lot of pressure. I mean, that's what happens when the people are unhappy about the economy. So I think, look, China gets through that. The other side to the argument is that when the US dollar goes down, commodities generally across the board become a lot cheaper for the rest of the world. More expensive for the US, but cheaper for everyone else. So, it stands to reason, this inverse relationship that the dollar's got with commodity prices has stood the test of time. We've seen gold lead on the upside, but I think other commodities follow, because, if you thought the US dollar was going to go lower, and you were a country and you're sitting on, billions of US dollar reserves, you'd be looking to swap some of those dollars for something real. So at the end of the day, I'm not getting bearish about commodities, given the growth scares we've had in recent weeks, and we have seen some of the damage, and I think it will come right. We know the fundamentals for copper are there over the medium to longer term. So, we know there's going to be a shortage. We know that production is not, and supply is not going to be able to keep up with demand. And, you know, the energy transition story is still there. That's not going away. You know, it's every day we get out of bed and we listen to more stuff about climate change, and we've just had the hottest August on record. And so, you know, the energy transition is real. We have to move into renewables. We know that the world is going to need a lot of base metals and steel, etc., to build that infrastructure. Ditto for AI. You know, with data centers, and we're going to need upgrades to the power supply and the power grid. So yeah, I just don't want to lose sight of all of that, and you know, and just stay focused on what the US dollar is doing, because you know the US dollar goes down, all things being equal, commodities have to go up.
Okay, and something we've been talking about, the first cut is the deepest, and I know tomorrow you're heading off to New Zealand, and they've recently cut their interest rates over there for the first time, and I think it'll be quite interesting for you to see kind of what the sentiment is like over there, given that that first rate cuts comes through.
Yeah, the first interest rate cut, has a huge psychological impact, and from what I understand, the mood in New Zealand has actually picked up quite a bit, because you know, if you own a house and you've been struggling to pay your mortgage, and you've had to cut back on spending, all of a sudden there's a light at the end of the tunnel. You're over the crest of the hill and you're on the downhill slope. So the psychological impact is enormous, and I think, you know, the first cut that goes in here will improve the mood of the country and add to the economy. But you know, that remains to be seen. In terms of what the Fed does, is it going to be 25 or is it going to be 50? That will come down to the state of the labour market. It's all going to be about that non-farm payrolls print and what the unemployment rate is. Any deterioration, I reckon they go 50. If the number comes in line, i.e. 185,000 new jobs added, the unemployment rate is steady at say 4.2, or even drops to 4.1. I think they go, but they just go with 25.
Okay, and that non-farm payroll number comes out in the US on Friday?
That's right, Friday morning before the market opens.
Before the market opens. Okay, so that'll be Friday night our time, and you know, we'll see it overnight. So I thought I'd also mention that given you're traveling tomorrow and you're heading back to New Zealand, you won't be publishing your daily note tomorrow. Is that correct?
That's right, Pat, but I will be providing a update to members on Monday, just to go through what happened in the labour market and what that means for the FOMC meeting in a couple of weeks' time, and more importantly, you know, what that means for everyone else, and you know, the significance of that for the markets.
Okay, so I think that pretty much covers everything. I think we got through a lot. It's been quite an interesting week, especially here in Australia with all that news out yesterday. But onwards and upwards, and we'll look at these non-farm payroll numbers coming out of the States and see where that takes us. And Angus, have a safe trip back to New Zealand tomorrow. And to all the members, we hope you got some value out of the presentation today. Thank you very much for joining us, and we'll say bye for now, and we'll catch you in a couple of weeks' time. Thank you.
Thanks, Pat.
Can you do me a favor?